Hi there, this is Helen Tarrant again from LA. Here with our whole team. Wow, it's massive. Hi, welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and I'm walking around this warehouse property here at the moment in Roseville. And I think one of the things that I don't talk about, and we haven't talked about in our group and on my videos before, is actually about depreciation in commercial property. See, you can depreciate obviously the building itself over 40 years, and of course certain fixtures and fittings. And of course your tenant pays for the fit out, but in certain circumstances as a landlord you are actually responsible for giving them some rental incentives or some fit out incentives. So if you're doing a fit out incentive, then you are actually then contributing to that fit out, and you have a right to depreciate it. And it may be, a sliding door, it may be, curtains, blinds, and etc. Or it may be something like, specialist equipments to be installed, or it could be simply things like cabinets and tables and chairs. So simple things. Or alternatively, you've just given your tenant a bare shell and they're pretty much doing all of the fit out. But whatever it is definitely worthwhile to look at depreciation, because depreciation in commercial property is twofold. Number one, you get depreciation because you actually want to write off your positive cash flow. So it actually minimizes the tax you pay on your commercial property cash flow. So let's say that you buy a commercial property and it gives you, say, $20,000 in positive cash flow, and on that same property, and that would be a strata premise, on that same property you could write off, let's say, $5,000 in depreciation a year. Well, what that means to you is that instead of paying tax on the $20,000 of positive cash flow, you are now actually paying tax on the $15,000. So it actually saves you the tax on the $5,000. Now, for someone who's on a high tax bracket and they're paying 40-45%, you're actually saving yourself somewhere around $2,500 in tax. So that, it's a paper loss, it's a paper deduction, so you actually put that money into your pockets. So there's that. Of course, later on when you're looking at selling the property and if there's capital gains, the depreciation does get added back. And of course, for more details of that, you've got to consult your accountant. But the reason that people use depreciation in commercial property is to actually minimize the tax they pay up front, so that you have more cash flow coming in. You can use that cash flow to accumulate another deposit, and you can keep going, right? And often it is for the high net worth, high people who are on the high income brackets that they use commercial property depreciation to actually write off some of the positive cash flow, so they're paying less tax. So if you are thinking that this is where you want to be and this is where you want to go, and you're looking at that particular type of property, some of the properties to look at is properties that are slightly newer. Not totally new, because if you buy a new property, you're going to be paying a premium. Property that are slightly newer, so maybe within 5 years old. Properties that have depreciation benefits because the vendor has given the tenant a incentive of a fit out, or they've helped the tenant by doing a fit out. So often when you're looking at a restaurant premise or a cafe, what you may find is that the vendor had actually gone in and actually put in a new kitchen, or they've done new tables and chairs and they've done some fit out for that property. Well, if that's the case, then you can depreciate that. Now, if you did go in halves with your tenant, say for example your tenant wanted to do an extension, or that your tenant wanted to fit out an extra room or convert a storage room into something that's operational, and you help them by not giving them rent free but a contribution, then you can come to an equitable situation where you agree with the tenant how much you can write off. So once you do a depreciation report, and a depreciation report costs somewhere between $1,000 to maybe $3,500, depending on how complicated and how big the building is. And of course, if you're buying a whole freestanding building, it could cost as much as $5,000. But ultimately, we've seen any depreciation from a couple of thousands of dollars to $200,000, $300,000, depending on what's been fitted out in the premise and what you actually get. So at the moment, as a prime example, we did a group deal down in Hamilton within our private group. So this is another thing, if you want to find out more, do reach out to me regarding that. But we did a private group deal, which is part of us doing a fund through, where we bought the land and we paid for the build of the actual petrol station. So in that sense, we're actually going to have massive depreciations because everything is new in there. And then we're going to be able to have the massive depreciation, which is going to write off the positive cash flow and therefore save massive income tax or minimize that tax for our unit holders in our group. So that's only done in a private group sense, and that's also an option in commercial property, is to get into a group as well. The way that commercial property is different from residential in terms of depreciation is that residential use depreciation to bring your property back to neutral because you're negative already, and then adding depreciation on it makes the property look neutral on paper, whereas in commercial you actually use it to write off the positive cash flow. So it's totally opposite to that. Any property can have depreciation. Obviously with freestanding buildings you're going to have more depreciation because there's a lot more items to depreciate and there's a lot more capital work you're going to be spending on the property. But the idea is to get a really good depreciation report once, and then as you do more improvements to the property you add to it going forward. So if you're looking for a strategy around that or a particular type of property that has good depreciation, reach out to me at helentarrant.com or helen@commercialpropertycashflow.com.au and we can jump on a strategy call. Or alternatively, if you're interested in one of our group deals, want to know how to become a private community and really join us and expand your knowledge on commercial property and join us and see some of the exciting deals that we've done, again, reach out to me at helentarrant.com, and I really look forward to helping you with my commercial property journey. Bye for now.